Good morning, everyone, and welcome back to Morning Markets on Tuesday, the 5th of May. A couple of things that we've been discussing as an investment team this morning that I'd like to share with you. Yesterday, we touched on the central bank meetings that we would have this week. We had the first of those from the RBA in Australia overnight. No change to interest rates as expected. And as we've discussed, the most important and more interesting aspect of these meetings is what policymakers say about the current situation and how they see it evolving over the course of the year. From the RBA's perspective, they see GDP contracting in the first half of the year some 10%, that translating into sort of a 6% number for full year 2020. They also touched on how they see policy going forward, and very much similar to that which we heard from Jerome Powell with the Federal Reserve in the US last week. They see policy remaining very accommodative to both the household and business sectors for the foreseeable future and possibly into the medium term. And why do I say medium term? Because they've touched on the two criteria that they are looking for. One, inflation moving back into their target range of 2 to 3%. We know that the latest inflation print was significantly below that. And then secondly, the economy needs to reach back towards full employment. And that's something that will clearly take time, given the number of job losses and the unemployment rate that they're forecasting as a result of the lockdown and the impact of COVID-19 on the economy. We'll hear from Andrew Bailey in the Bank of England towards the end of this week, and that will provide some contrast to that, or maybe reinforce the messages that we've heard from the RBA and the Fed over the past number of days. The other story that we were discussing today as a team was just the announcement from the Federal Reserve yesterday, where they were putting together and finalising the details of the bond buying, so the corporate bond buying programme that they would be enacting both in the investment grade and in the high yield space as part of the stimulus package. So it's about a $750 billion programme that will be enacted over the coming weeks. There's a number of criteria that they've attached to that, such as where they will buy, i.e. if they're buying in the ETF market, they will be looking not to cause any disruption there. So if an ETF is trading at a premium, they won't buy at that issue at that point in time. They also will be buying potentially the debt of foreign companies that have a significant part of their operations in the US, and they've provided criteria around that. I think one of the things here that's really interesting and speaks to the discounting mechanism of markets is the fact that this programme hasn't spent a single dollar as yet we've seen quite significant performance and material performance with spreads narrowing relative to treasuries for both investment grade and high yield over the past couple of weeks, indeed since it was announced that the Fed would be intervening in these markets. And to give some context around that, April was one of the biggest months that we've seen in the past number of years for issuance of US investment grade credit. And then just to really bring it home, Boeing, one of the companies that I think we would all argue is at the centre of the current storm, was able to raise $25 billion in the investment grade market just last week. Yes, it did have to pay a premium relative to historics, but it does show that market is clearly open, and one that when we have got the Fed as a backstop is clearly very supportive. Indeed, over the past number of weeks in discussions with our managers, we've seen a clear preference for investment grade credit as an area that they think is attractive from a risk adjusted return perspective over the medium term. In other things, just today, we touched very briefly on some of the PMI data that came out of Europe yesterday. Again, as we've said many times in the past, backward looking. But I think probably of note it was pretty much in line with expectations, so whilst the deterioration, it didn't deteriorate more than had been expected. And we get UK PMI data later on this morning, and I'll come back and discuss that tomorrow. Many thanks for watching, and have a good day.